Welcome to Cash Chats with me, Andy Webb from BeCleverWithYourCash.com. This is the podcast to help you make the most of your money. Episode 356 is a bonus one where we're looking back at the big news stories over the last 4 weeks when it comes to your money. We called it Your Money This Month. So much we could have spoken about, proposed changes to Royal Mail, insurance after the floods and storms, Apple paying out in the US after they were found to have deliberately slowed down iPhones, and potentially that might come to the UK as well. But we haven't covered those. We've covered loads more. I'm joined by a guest, Oliver Smith from ep356, and we'll take you through things such as what could be coming up in the budget, what the predictions are for the base interest rate, potential changes to pricing when you buy lots of bundled things together, loads more. So I hope you enjoy. Here we go, episode 356 of Cash Chats. Oliver, thank you so much for joining me on Cash Chats to go through a lot of news. We've had a lot happening in January. Before we do get into that though, do you mind sort of telling everyone listening and watching at home who you are?
Yeah, my name's Oliver Smith. I'm the managing editor of ep356, which is an industry publication that covers the ins and outs of fintech. So we cover digital banking apps, alternative lending, basically any challenger financial services.
Fantastic. Well, I thought let's go back to the beginning of January, or near to the beginning of January, because there was something that happened then which we might be getting the effect of, or noticing the effect of any day now, when for most people getting paid at the end of the month. And this was that national insurance tax cut. Can you sort of share with us kind of what actually has happened here and what people might be sort of looking at?
Yeah, so at the start of the year, 6th of January, the national insurance rate was cut from 12% to 10%. It was part of the autumn statement at the end of last year, and it impacts your sort of class one contributions, which most people who are employed by companies will pay. And I guess the main thing is, what does that mean for me? What does that mean to my payslip at the end of this month? So the average person in the UK, the average salary is £35,000. And for someone on that salary, they should see about a £448 a year decrease in their national insurance contributions, which sounds really, really good.
Yeah.
But obviously with all these things, the government gives and the government also takes. So the analysts who have looked at this news said, this is good, but also because the income tax thresholds haven't changed for the last few years and aren't going to change, they've been frozen until 2028. What it actually means is that especially lower income earners are going to be paying more tax. So if you earn £26,000 or less, actually you're going to be worse off, even though some people are going to be doing better from this. So it's a bit of good and a bit of bad.
Yeah, absolutely. It certainly is. Those people who are earning sort of 50 to around 50k mark, they're the ones who are going to really benefit the most from this. Freelancers, there's also been some, if you're self-employed, there's also been a change there for their national insurance. They'll be, again, slightly better off as a result of this, but it's a great bit of sleight of hand. Like, yes, a lot of people will have more money that they take home, but over that kind of, as you say, short period, that kind of fiscal drag, as they call it, don't they, when the tax thresholds haven't increased, it is going to mean we ultimately then pay more. And what's interesting about this kind of sense of like, there's an election year. We know the election is going to happen in 2024. So this was almost like the starting gun. Look, we're cutting taxes, and I think they can tell everyone they've done. And we have seen some speculation about what we're going to see in the budget set for March the 6th, I believe, which could see yet more of these kind of tax cut promises. What have the kind of papers been reporting that the Jeremy Hunt is possibly going to be looking at?
Well, there's a few suggestions. I mean, the Telegraph have said that the Chancellor could be cutting income tax by 2p and maybe even making further reductions to national insurance contributions. So maybe, I know we just said that the cuts that have just been made are slightly misleading. Some people won't do better. Actually, potentially he might go further, which is good news. The devil is always in the detail, so it really depends. What's the actual detail of what gets announced? As we've seen before, we've got to go through the details to figure out what's happening. The second thing is potentially the either reduction or abolition of inheritance tax. So this is the 40% rate which you pay on your estate over £325,000 or up to £500,000 for if a home is included in that. Tory MPs have been lobbying for years to get this either scrapped or increased. it's definitely a winner among kind of the core conservative, slightly older, slightly wealthier audiences. But I guess the calculation that's probably going on in number 10 and number 11 at the moment is whether it's worth making changes, whether that will really shift the dial when it comes to that election, which we know is coming around.
Yeah, I mean, absolutely. That inheritance tax, either scrapping it completely or cutting it, it's really one of those things that people, oh yeah, I don't want to pay this, but most people don't pay it. It is only the really, really, really rich who are impacted by this. So any cut to it is going to only really help people who are already very, very, very well off. But again, the majority of people, if this is announced, it's not going to make any difference to you. And what was interesting as well, that we've seen the IFS, the Institute of Fiscal Studies, come out and say that if there are any further tax cuts to income tax thresholds or even more national insurance cuts, the likelihood is, I mean, this is kind of common sense in lots of ways, the way the economy is going, that we will probably see spending cuts on our services to cover that. So we might think, oh, look, I'm paying less tax, but in return, your services are going to be worse. They're going to be reduced. Or if they don't cut the spending completely, then later on, they just have to, whoever gets in will have to increase taxes. And there is a clever thing going on here, I suppose, where they're kind of like, look, we're the party who will cut taxes, and whether they get in or out, if Labour do win and have to increase taxes, then there's going to see as a bad thing. But you can't keep cutting taxes and expect services to remain where they are. And already so many of these are massively underfunded, aren't they? So yeah, it's when we have that on March 6th, obviously we're due full coverage here on becloveryourcash.com. It'd be interesting to see quite how many of these promises come along are blatant electioneering, and how many of them actually kind of, things that are good for us as individuals and good for the economy. There are a couple of things that have been sort of mooted as well within this budget as well, which might be more useful. There's talk about child benefit thresholds changing.
Yeah. So the current rule says if you earn over £50,000, there's the high income child benefit charge, which essentially means that once you start earning over that amount, the government will claw back parts of that child benefit that's given to you. Now, and essentially by the time you earn £60,000, you don't get anything.
Yeah, it's crazy, isn't it? Because you could have like a household where one person, two people earn 50k, they can get it. One person earns 100k, they don't get it at all. It is an unfair system the way it's set up right now.
It's super unfair. And the other thing is, if you're within that bracket as well and you want to claim child benefit, you also have to go through the self-assessment process at the end of every year, and then pay that back as tax. It's a really frustrating scheme the way it's set up at the moment. So there's a little bit of talk about maybe raising that threshold, which would reduce the number of people affected by it. But again, it's got a long way to go. The system as a whole probably needs a bigger rethink.
Yeah, well, fingers crossed there is something that we get going on there. Hopefully, again, don't know whether they will. There's still a lot of pressure, again, to try and make some changes to the lifetime ISA. But again, there's always this pressure and there isn't much change. So it'd be good to know if we do see something in March, that would be amazing. The other thing that I've seen reported a fair bit is around, there's always something to try and help first-time buyers, isn't it? And what they're kind of talking about this time is a 99% mortgage, which, sounds like it could be a good thing if it comes along. I mean, could it be good for people?
Probably not, or maybe it'll be good for a very small number of people. There's already guarantees by the government on 95% mortgages, so we're really playing in the tiny numbers here. Most people, when they buy a house, it isn't the size of their deposit, which is the restricting factor. It's the bank's willingness to lend against their salary, which typically is about 4.5 times your salary. That's what restricts most people. Being able to reduce your deposit even further, potentially owning only 1% of equity in the property, that is, maybe opening up more problems in the future, especially around negative equity. Sorry, I butchered that. Especially with house prices, the way they're moving at the moment, prices could easily drop more than 1%, which would leave people in a really difficult situation when they come around to remortgaging.
Yeah, absolutely. And if this the other way around, if it did kind of trigger loads more people on them able to buy a house, what does that often mean? It means prices then go up. So then you need to borrow increases. So yeah, well, we'll see what happens. Again, these are all speculation right now, so we don't know whether we'll see them or versions of them. Talking to mortgages though, we have seen, I've seen a few people calling it a price war because mortgage rates are falling slightly. What's actually what's really going on here?
Yeah, so one or two providers are coming to market with rates below 4%, which is great to see. So Nationwide, 3.84% on their 5-year fix at the moment. I've got a lot of friends who are, waiting to see that below 5%, below 4%. The reality is that the average 2-year and 5-year fixes are still above 5%.
Yeah.
But this little bit of competition is certainly good news. There are some providers in this space, Santander, for instance, actually raising their rates at the moment. They're pointing to inflation and saying, look, this is not the time to be cutting further. So, there's activity, which is good, but certainly we need a lot more players coming to market with lower rates before, some people get comfortable, ready to remortgage.
Yeah, it was strange that Santander, they made a big press release about cutting their rates, and then a few days later they put them up again slightly. So I think it's good to see, as you say, it's good to see these rates starting to come down. And if you are someone who's in a position right now where you do need to remortgage and you waited out or whatever, this is good for you because you will be saving money compared to where you were 6 months ago. Compared to where we were, 18 months, 2 years ago, we're still massively, massively, massively up on those rates. So there will be still a step change. You're going from very, very historically low mortgage rates to still relatively high ones. So don't get too caught up about this news that they're falling. Yes, they're dropping a bit, but it could well be that this is how much, the drops are already priced in for the foreseeable future. And a lot of that comes down to the other I say it's a big surprise. It wasn't a big surprise, but there was a bit of a unexpected increase to inflation in, it's January's update for December's figures. We saw it increase to 4% from 3.9%. And previous months, we've seen lots of drops. So this is the first time we've seen an increase in quite a long time. And that was unexpected. They did kind of think it would drop down a little bit. So that little increase, what's kind of caused that? Why did it go up rather than go down?
Yeah, so it was driven by a few things in particular, alcohol and tobacco prices. As you said, the expectation was that it was going to drop further to 3.8%. So it surprised people by that. What's the knock-on impact? Well, we're all expecting some base rate cuts this year. Potentially that is going to push that timeline back a bit, which is not good news. We were just talking about mortgages. It's probably not good news for people who are holding off for way lower mortgage rates. Those people who are saving, maybe that's good news because it means those rates may stay in the market a little bit longer. But it means that, so those rate cuts which were on the table for this year, maybe not quite as certain that we'll be getting way down, maybe 4% this year yet.
Yeah, well, I mean, every single month, whenever we have every 6 weeks, we have the Bank of England meeting. The next one is actually on Thursday in a week's time on the 1st of February. I always do my update article, update video, update podcast episode, taking you through what this means and also what the latest predictions are. And every time it changes. You can't say nothing is nailed on in this world. And what the current speculation is that we will see still a number of cuts this year, but maybe they won't be as early as expected. Some people at one point, people were talking about in maybe March, if not April, May, to see that first cut. Maybe that might push back a little bit. And maybe, as you say, we won't get all those predicted 5 cuts, bringing us from 5.25% down to 4% within 2024. But that's what we're saying today. In a week's time, I'll do that update video, that update episode of the pod, and I'm sure there'll be different predictions. But it does mean, when we're talking about mortgage rates and savings rates, they are changing those based on those larger market predictions on the base rate. So we've been talking for a while now about mortgage rates, the interest rate, base rate dropping, and mortgage rates have been pricing that in. So, it might, as you say, whether we see more of these mortgage rates, probably unlikely. Savings, I do think we will see we've seen a huge number of cuts recently, and I don't think this inflation thing will change that at all. I think they're kind of, right, here's our excuse to drop rates because they always they're fast to take money off us, but they're slow to give it back to us. And this is a good opportunity for them to, not give us as much. So inflation's gone up, and that is not the only thing that is going up. Bills. This is the time of year when a lot of the big providers, often mobile and broadband companies in particular, they start to kind of tell you just how much prices are going to go up. And often it is based on that inflation figure. What have we seen so far?
Yeah, and these are the mid-contract price hikes. So these are the ones that you can't really get out of. If you've signed a contract, you're probably going to get hit by them. So increases of 4% plus 2 to 4% on top of that inflation figure. So if you're an E or a BT customer, that's about 7.9% increases coming down the line for you. 3 Mobile is doing 7.9% as well. TalkTalk 7.4%. If you're out of contract, this is the kick that you need to go and shop around the market, see what else is out there. And if you're approaching the end of your contract and you're thinking about switching, this is why it's so important to shop around and get a good deal at the beginning, because these increases will come. So you've got to get the best deal you can. Now, these mid-contract rises maybe are coming to an end in the future. Ofcom has proposed that they're going to ban these inflation-linked rises. They want providers to move to more plain and simple pounds and pence increases that are all stated up front. So when you sign the contract, you know what you'll be paying. But that's going to be a slow process. BT and EE have said they are going to do it, but not until 2025. All the other providers have been much quieter. So we'll have to wait and see.
Yeah, it was very cheeky from BT and EE. Had these great headlines you saw that they are, BT scraps above inflation price hikes, but not yet, not this year. This year, we're still going to put it up by inflation plus 3.9%. So sadly, as you say, many of us, we can't do much about this. It's worth thinking about when you sign a new contract right now as well, maybe because you will be baking in that increase again for next year if it's in the contract. So if you are coming to the end of a contract right now, you're looking to switch right now, you could still see an increase, because although they've announced the hikes, they don't generally come in until the 1st of March, the 1st of April, something like that. So just be aware of that over the next few months. Yeah, and they're not the only ones hiking prices. This is a cheeky one from Amazon. If you have Amazon Prime, you're paying either $8.99 a month or 95 quid a year to get all these extra services, and that includes the Prime Video. But what Amazon have are introducing actually from the 5th of February, so you haven't got long now, they're going to start charging you an extra $2.99 every month if you want to avoid adverts on Prime Video. So again, you don't have to pay this. So you're not forced into it. But effectively, if that's one of the reasons you have Prime, this extra charge is a sneaky price hike. So it's definitely worth, what I would say to anyone is if you have got Amazon Prime right now and you think, oh, I don't know if I want to keep it after this extra charge comes in, you've got a week to binge as many of those shows that you haven't watched yet, those movies, spend a week watching it and then cancel it. And remember with Amazon Prime as well, really important here, you don't have to pay up front for the whole year if you don't want to. You can pay monthly. And I would suggest that you just take it every now and again. Don't keep letting it renew month after month after month. Just have it when you actually need it. Try giving a break from it. And that hopefully will save you money. You might realize you don't need it all the time. And interestingly, while we talk about streaming services, something also happened this week, actually, from Netflix. They announced that they have been doing really, really, really well since they introduced the subscription sharing crackdown, which means you had to buy your own passwords. A lot of people thought, well, maybe they won't do this. People won't pay for it. They are paying it. More people are signing up. And they're actually going to be scrapping, if anyone's still on that legacy package of Netflix Standard, which if you were on it when they scrapped it last summer, you could stay on it at some point this summer. That's going to go as well. So we don't know yet quite how you're going to be forced either down to the one with adverts or up to the more expensive one. But for those people, there is that change coming along. Was one more price hike worth talking about here as well. And this is around car insurance, because this is shocking just how much car insurance has gone up, isn't it?
Yeah, I think a lot of people realized already, if you renewed your car insurance last year, you may have been surprised already. But now Confused.com have published their analysis of last year. So all those price rises, what have they meant? And actually, it's meant that the average cost of car insurance in the UK last year went up by 58% to £995, so just short of £1,000.
It's amazing, isn't it?
It's wild. Obviously, some people are being hit worse than others, new drivers especially, having their premiums double from about £1,400 up to nearly £2,900. I know EVs have been hit very hard as well. Some people maybe not quite as much, but certainly most people who are shopping around, comparing the market, have been stung by this. Why is it going up? Well, the insurers are blaming high inflation, repair costs, the number of people claiming. But I think there's real questions to be asked. I think people are getting increasingly frustrated because they're such big increases and they're out of line with, all the other percentages we've spoken about in this show. These are way above.
Yeah. A 58% increase on average is, that is ridiculous. It really, really is. I mean, sadly, all you can do is, well, you can shop around, get other quotes in, or you can phone up your provider and see if they'll do anything about it. But even if you can get a lower price than the auto renewal that comes along, it's not going to be anywhere near what you were paying. They're not going to knock the equivalent back to where you were. So yeah, I mean, we've got our car insurance is due around this time, actually sort of January, February time. So this will be a kind of a big shock. And I think for a lot of people, they only really experience this once a year. So you kind of forget about it. And suddenly to see such a big thing is quite shocking. And actually some more news this week from Which they sort of shared some research. I mean, to be fair, I mean, this is relatively obvious, but it's worth kind of reiterating it, that there is a premium if you pay for your car insurance monthly. It's around £300, I think, on average, if you don't do direct debit rather than upfront for a year. And that's always been the case with home insurance, travel insurance, all these things. Generally, paying upfront for all of it will save you money. The problem is, if we're looking at an average of £1,000 to pay upfront, I mean, how many people have actually got that? You don't have that money sitting around on the whole. We know as a nation, most people don't have that much in savings. So that means you will pay extra because you don't have the money and you have to go for the monthly payments. You're going to pay more. So there are a few ways that you might be able to mitigate this. Of course, people could start saving now if they know car insurance is coming up. Start saving, putting money aside. So hopefully you can get enough. But again, if that is in the next sort of 2 or 3 months, that might be a struggle to get £1,000, or if you're a younger person, even more than that. You could look at 0% purchase credit cards, maybe that either using them for the insurance or maybe put other spending on that just to free up a bit of cash. Just really important, obviously, with those cards is to always make that minimum repayment every single month so you don't lose that 0% period. There are covered it on the channel and on the podcast just last week, some 0% overdrafts that are available. You could look at one of those. Again, might help you a little bit getting that money up front. But yeah, I think the big thing here is just start saving every month towards that car insurance for the following year when there are these kind of absolutely crazy prices.
I'd also throw in, just as a low mileage driver myself, looking at pay by mile car insurance. Okay. If you're not a high mileage driver, sometimes that can also work out quite well. But as your usage may vary.
Yeah. So there's not the only thing that cars have hit the news for this month, are there? There's something that could be quite interesting for anyone who's been buying a car on things like hire purchase or PCP.
Yeah, so car finance, like you just said, it's used for 80% of new car purchases at the moment. If you walk into a showroom, odds are you're going to be they're going to try and sell you one of these credit facilities. Now, before 2021, the rules were a little bit different, and it meant that the car dealers who are selling that credit to you could actually adjust the level of interest on them in order to get a higher commission. It's crazy talking about it.
It's absolutely ridiculous, isn't it? Yeah.
It was an age long before Consumer Duty or any of these, the way we think about things now. Fast forward to today, the Financial Ombudsman Service has actually ruled in favour of 2 customers who took out credit and were charged a higher rate because the car dealer jacked it up to get a higher commission. And that has triggered an FCA investigation. Now, this may take a while. I don't think overnight things are going to change. But if you do have a car finance agreement from pre-2021, it's worth keeping an eye on, because if mis-selling is found to have happened, this could lead to compensation in the future. It's best to wait and see. If anyone approaches you, if companies start emailing you, telling you to, you can get all your money back and stuff, I would ignore it for now. Just keep an eye on things. But it's worth paying attention to, because in the future you could be owed some money.
Yeah, and it might even be worth putting a complaint in now, isn't it? So you're in the system just in case the ruling comes out that it's only going to go to people who've already complained. Get something in now, and you might have a better chance of getting money if, as you say, we don't know if something does come about. One last story now. This is a nice one to end on. It's a much more positive one, and this is a new ruling that's hoping to come into play in the spring. The kind of law that this is part of is currently going through Parliament. So again, there's never any guarantee, but it's looking like we are going to see some consumer protections when it comes to something called drip pricing. What is drip pricing?
The language is terrible, isn't it? Drip pricing, the clearest example I can think of is if you've ever bought tickets for a gig or a concert, or maybe you've booked a flight or an airline ticket. Sometimes the price that you're shown at the beginning of the process and the price you get to at the end of the checkout has all these fees added on, commissions, taxes, and it becomes really, really hard to compare 2 products to each other, 2 tickets on 2 different websites. So that's what they're trying to get rid of. They're trying to make sure that the price that's promoted is actually the price that you pay at the end of the checkout experience. This should make it a lot easier to shop online, especially for things like flights, hotels, transportation, or, as I said, gig tickets, which are definitely, the worst offender of doing this.
Yeah, I remember years ago, I wrote something sort of looking at all the different ticket providers and sort of adding up just how much different the fees were. And they varied from like 99p to £8. There was such a variety of charges. And the big thing about this drip pricing, these rules that come into play, is the stuff that you can't avoid. If that provider, again, an airline, a ticket agency, whoever it might be, say you must pay this, you have to pay it. So they'll be showing that up front. And that will make it easy for you to compare prices because you'll see the like for like of actually what you'll pay. There are obviously going to be a few exclusions there because certain things are kind of optional extras. So if your flight doesn't include hold baggage, that won't be shown because that is something you can add in, or priority booking. When I was reading about this, I didn't see anything about delivery charges. So again, I imagine you're still going to have to compare prices there because often you'll have some options. You have how fast you want the delivery, whether you want to pick it up, collect it. So I imagine delivery will still be extra on top of this, but certainly good news. And also part of these rulings, they're going to be banning fake reviews, which will be fantastic as well, because they can be so misleading. The likes of Amazon in particular, you go on there and you see these 5-star ratings, and then there are also an equal number of poor ratings. You think, well, what's going on here? And it's because they've paid people to do this. Either real punters who have bought something, they've incentivized them to put these reviews in, or they've just farmed them out to review companies that just spam all this stuff. So I think that'll be good news for us as consumers as well, won't it?
Definitely. I mean, it's still got a long way to go, and often these laws have a habit of getting changed during the process, but we cross our fingers and we hope that by spring, maybe we'll get some of these consumer protections in place.
Oliver, thank you so much for joining us on today's episode. We've gone through a lot, so many things, more things I'm sure we could have covered, but it's great to kind of catch up on this stuff and share with everyone what's been going on. Thank you so much.
Thanks, Andy.
Well, thanks everyone for watching this episode. We'll be back on Tuesday with another normal episode of the show. You can download Cash Chats on Apple Podcasts, Spotify, wherever you do get your podcasts, or you can watch episodes on our YouTube channel as well. So however you like to consume content, you've got a way to do it. My name's Andy Webb. Thank you so much for listening. Till next time, cheers.